federal efforts to bolster job creation need to connect the macro to the metro. More specifically, our research shows that the federal government must address the needs of metros and their contribution to the economy in two ways, both fundamentally related to the discussion of infrastructure. First, the federal government must act quickly to stop additional job losses that are large and foreseeable. It does no good to bring new jobs in through the front door if we're losing old jobs out the back window. Perhaps the best example of the folly of focusing exclusively on job creation and ignoring job preservation comes from our nation's transit systems. As the federal government's Recovery Act funds aim to create so-called shovel-ready temporary construction jobs, transit agencies are facing the likelihood of laying people off from stable, permanent positions. No fewer than 51 transit agencies around the country are facing some combination of service cuts, fare increases, and layoffs. These systems, which are vitally important to move people around in major metros like New York, Chicago, Washington, Boston, LA, Philadelphia, have all recently considered job cuts, service reductions, and/or fare increases to close millions of dollars in deficits. St. Louis Metropolitan Transit Agency had to lay off a quarter of its staff, and this is at the same time when transit use is actually increasing in that metro. The Recovery Act provides about $8.4 billion to be spent on transit this year, but federal rules stipulate that this money can be spent only on capital improvement projects and not to finance gaps in day-to-day operating expenses for large transit agencies. So one of our recommendations in the short term is the federal government should step in and allow transit agencies to spend capital stimulus dollars on operating expenses during this emergency period. Now, beyond these immediate interventions, metros also need the federal government's support in creating jobs that build an economy of the future, low carbon, innovation fueled, more export oriented. Investment in the next generation of infrastructure is critical to this future endeavor. And we need a broad definition of infrastructure so that we can move people, goods, ideas, and energy effectively and efficiently. Now, we all know that the current programs and policy do not deliver the kind of infrastructure we need. The federal government has not only failed to invest sufficiently in next-generation infrastructure, but has also failed to allocate resources in a way that maximizes the return on investment. We have built bridges to nowhere precisely because many infrastructure efforts are dictated more by politics than by national priority and by a market logic. So we need to invest, but we also need to reform.